If you want to be a stock market investor, then when you buy an investment, your goal should be to own your investment for at least a year. Because if you don't own your investment for at least a year, then you're also going to be subject to higher taxes, because the way that the tax code works, if you own your investment for longer than a year, then that's categorized as long-term capital gains and you get lower tax rates. But if you buy a stock and sell it for a profit in less than a year, then you're going to be subject to higher taxes called your ordinary income taxes, because the United States government and the IRS doesn't look at that as an investment, because now you're just trading, you're flipping stocks. This isn't to say that you cannot make money trading stocks. This is for you to understand what your goal is as an investor, because if you don't know what your goal is as an investor, you're not going to be able to come up with a strategy. On the very highest level, there are two different kinds of investment strategies. There is an active way of investing in the stock market and a passive way. An active investment strategy means that you're now actively researching companies and stocks and you're buying based off of that. And passive means you're not really doing much research. You just have some money automatically being invested for you every week or every month. Now, within this type of active investing, there's a whole bunch of different strategies that you can use, but they ultimately come down to doing two different types of research. You can either do fundamental research, so I'm gonna call it fund, or technical research. Or you can also do both depending on what strategy you have, but those are the two types of research you can do, fundamental or technical. As a passive investor, you're mainly going to be looking at the fundamental type of research. Fundamental research means you're looking at the company itself. You're looking at how much money a company is making, what their profits are, who the management is, and how they're innovating. Technical research means you're looking at stock charts. You're looking at momentum. You're saying, oh, this company looks like it's about to go up because of all these indicators, and so you buy based off of that. Warren Buffett is a fundamental investor. He likes to look at companies, he likes to read financial statements, and he wants to find a company that's undervalued, and he wants to own it for a long time. That way he can make a profit over the long term. And he is an active investor because he does the research to actually find the companies to invest in, and he is the one that's picking these stocks and doing this research, and he makes these decisions when he thinks it's a good time to invest. You can compare that to a passive fundamental investment, where now you can pick a few stocks or a few funds that you want to own, and then every single month you have $100 or $1,000 or $10,000, whatever you can afford. You have this money going into your investments, being divided up into your 3 or 5 funds, whatever you have, and this is just passively happening without you actively trying to find new funds. It's just every month or every week, more money is just being invested into your account. Technical trading is now when you're looking at stock charts and you're looking at momentum. You're looking at different indicators that tell you that you think the stock price is going to go up. Maybe you're looking at how many people are buying the stocks of the volume. Maybe you're looking at moving averages to kind of see the trend of which way the stock price is moving. So you're looking at different indicators to tell you that you think the stock market is going up, at least in the short term. If you don't like the idea of putting time into the stock market, or if you don't care about studying companies, or if you don't care about stock charts, then passive investing is probably best for you, because this one requires the least amount of work. You find a few stocks or funds that you want to invest in, and then every week or every month, you are just going to continue to put money into that. If you like the idea of looking at companies, but you don't like the idea of looking at stock charts or looking at these moving averages, you just want to invest in a company like Warren Buffett does because you want to find an undervalued company and invest in it for the long term, then being an active fundamental investor is probably best for you. If you don't like the idea of waiting years to potentially see a profit, then technical investing is probably better for you. Now, while technical investing can make you the most money in the short term, it also comes with the most risk, because your goal is to make money in a shorter amount of time. A lot of technical investors are buying and selling stocks within a year. Fundamental investors are usually looking to make money over the long term. So now we're talking multiple years, and so there's less risk, but also less opportunity to make a whole bunch of money very quickly. For the vast majority of people who don't care about studying companies or reading financial statements or spending time learning the stock market, passive investing is the right way to go. Fourth, let's talk about the different types of investments on the stock market, because one way you can invest in the stock market is by investing in stocks. But that's not the only way that you can invest in the stock market. You can invest in the stock market and make money in the stock market by investing in individual stocks. You can invest in mutual funds, you can invest in index funds, and you can invest in ETFs. If you are subscribed to our YouTube channel, you've probably heard me talk about these things before, and if you're not subscribed to our YouTube channel, you should probably do that. Stocks are when you're investing in individual companies. This is what I've been talking about most of this video. So if you invest in the McDonald's company, or in Lululemon, or in Tesla, or in Amazon, or in Apple, now you're investing in individual companies. And within the stock segment, there are different types of stocks out there. Like, you can invest in blue chip companies. These are your more stable, more established, your larger companies. You can invest in growth companies. Growth companies are your startups, your smaller companies. These are companies that are investing heavily into their growth. So growth companies are not companies that are paying out dividends. These are companies that are spending every dollar they have back into their company to grow as big as possible, as fast as possible. So more risk, but the opportunity to see more appreciation. You have things like REIT stocks. REIT stocks stand for real estate investment trusts. These are companies that pay out high dividends because these companies make money through rent, and the law says that REIT stocks are required to pay you 90% of their taxable income through dividends. So REITs give people exposure to real estate, and you can make income through dividends without having to go out and physically buy real estate. So these are a few ways that you can invest in stocks. And again, you want to invest in stocks based off of your investment strategy, your investment goals. But this isn't the only way to invest in the stock market, because the downfall with investing in stocks is if you invest your money in a stock, let's say Amazon, and Amazon starts to fail, they start losing money and they go out of business, then all of your money goes down the drain. Now you might be thinking, oh, Amazon's never gonna fail. But you know, companies do fail. And if you invest in a company that fails, then all of your money is gone. That's where these options come in handy. Mutual funds are indexes, so a group of stocks that are managed by a very experienced and usually a very expensive money manager. So when you invest in a mutual fund, you are paying this money manager to find you a portfolio and investment of stocks, and this person is going to manage your stock portfolio, and their goal is to help you beat the market, and in exchange, you're going to pay them a fee. Index funds work very similar to mutual funds, except with index funds, you're not paying a money manager to manage your account. This is passively managed by a computer. So essentially with an index fund, you can invest into an index, like you can invest into an index that gives you exposure to the top 500 companies on the stock market. And now if these top 500 companies go up, your index fund goes up. If these top 500 companies go down, your index goes down. The advantage with index funds is you tend to have low fees, you tend to have less risk, and you can typically match the returns of the stock market. The downfall is you typically have less potential upside because you might have some great companies in your fund, but they're going to be balanced out by the losers. But this can be a good way for you to invest and get low fees and get exposure to the general stock market. An ETF is an exchange traded fund, and this is kind of like a basket statement, because all this means is this is a fund that you can buy and sell on a digital stock brokerage. So the reason the word ETF even exists is because a lot of mutual funds cannot be bought and sold on the stock market. If you want to buy a lot of mutual funds, you have to call up a broker and purchase shares of a mutual fund manually. With an ETF, it's all electronic, so you can buy and sell shares of this ETF kind of like you would any other stock. Now look, I am just a random guy on YouTube, okay? So you should always do your own due diligence and never blindly listen to a random guy on YouTube, because investing has risks and you are never guaranteed to make money when you invest. But a couple examples of index funds that give you exposure to the general stock market are VOO and SPY. If you invest in one of these two funds, you will get exposure to the top 500 companies in the stock market, and now you don't have to go out and try to find the best stock to invest in. Now you're investing in the general stock market. I want to kind of give you an idea of what long-term returns in the stock market look like when you play the stock market for the long game. So over the long term, the stock market typically goes up by somewhere between 7 and 10% a year. Now, this doesn't mean the stock market always goes up, and this doesn't mean that it always goes up by 7 to 10% a year. This means on average, it goes up by 7 to 10% a year. Some years it'll be more, some years it'll be less. Sticking with the lower end of the equation, let's say you invest $10 a day or $300 a month, and you can get a 7% return on your money. And let's say you do this for 45 years. So you start doing this when you are 21 years old, and you continue to do this until you retire at 66. If you do this and every single month you invest $300, you will retire with $1.1 million from your $10 a day investment. The reason I want to show you this, because let's say you start a little bit later. Let's say you start investing not at 21, but now at 31, and you continue to do this until you're 66. So now this is 35 years, but you're still doing the same investment. You're still doing $10 a day or $300 a month. Now, if you do the same investment, you're not going to retire with $1.1 million. You're going to retire with $535,000. Still a lot of money, but you're leaving a lot of money on the table because your money doesn't have as much time to compound. Time is very important when it comes to investing your money over the long term, because every single year your money has more time to grow and compound, and the longer you let your money grow, the more wealth it's going to build you. If you want to grow your money even more, then there's two things you can do. You can either invest more money, or invest your money more aggressively, meaning get a better rate of return. So let's assume now that you're investing $20 a day and you continue to get the 7% return a year. If you do this for 45 years, so you start when you're 21 and you continue to do this until you're 66, then you are going to retire with over $2.2 million from your $600 a month investment. If you cut 10 years out of the equation because you didn't know about investing until you're 31, so you do this for 35 years, now you will only retire with $1 million. Now, I know, only $1 million. $1 million is still a lot of money, but you're leaving a lot of money on the table by not starting sooner. This is where a lot of people say things like, oh, I didn't start investing when I was younger. Did I miss my shot at becoming wealthy? Is it too late for me to start investing? No, it's not. Remember what I said before. If you want to get better returns, you either have to invest more money or invest more aggressively. Maybe you have to invest more money, or maybe you have to be a little bit more active with your investments. That way you can get a better return. So now let's go through this example again, where you're investing $20 a day and now you're a little bit more aggressive. So you're trying to get a 10% return. If you do this for 45 years, just to show you the example, now you're going to end up with $5.5 million. If you start a little bit later at 31 years old and you do this for 35 years, now you're going to end up with $2.2 million. So you're still a millionaire. And if you start this at 41 years old, now you only do this for 25 years, you're still going to end up with $750,000 in retirement. So time and consistency are very important for you to build this wealth over the long term. And if you're trying to make up for this lost time, then you need to either invest more aggressively or invest more money. And if you don't have extra money to invest, then you might have to look into doing something like a side hustle or starting your own business. That way you have extra cash to invest. That way you can build your wealth. And this is also more of a passive investing structure. Right now, you're not trying to get amazing returns. You're just trying to match the market by passively investing your money into a fund that gives you the same returns as the stock market. Active returns can get you better returns, but again, it comes with more risk. Like if you had invested $10,000 in Amazon back in 2010, that $10,000 investment would have grown to $170,000 in 2020, but that again comes with more risk because there's a lot of companies that didn't get the same returns as Amazon. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.